What are the main differences between index funds, mutual funds, unit trusts, and ETFs? If you've ever been confused about these terms, then you are watching the right video.
When I first started investing, I didn't know what the difference were and I jumped straight into mutual funds, also known as unit trusts from where I'm from, and I didn't fully understand them. And it's only later on that I discovered that these unit trusts didn't have some features that I personally really wanted at the start. That's why I believe it's crucial to understand these investments beforehand. So let's kick things off with mutual funds, the OG of the investment world.
They have been around in some shape or form since the 1800s, where investors pool their money together to buy into multiple assets to spread the risk around. Some people speculated that it originated in Britain in 1868, where the Foreign and Colonial Investment Trust became what is believed to be the first such fund in the world, before the idea made its way into the US. Now, why would you consider mutual funds? Well, for three reasons: convenience, diversification, and professional wealth management. With just one purchase, you can own a plethora of stock. Plus, the risk is spread out by a team of experts. But it's not all sunshine and rainbows. The downside comes with its fees. The active management means you're also paying for those expert decisions. A common term that is floated around is the 2 and 20 split, where funds would charge 2% annual fees and a 20% performance fee. This means that they will take a 2% fee no matter what happens, and if the stock were to appreciate above a certain level, they would take 20% of that performance. Moving on to index funds.
These were introduced in the 1970s by a genius, not like her, named John Bogle, the founder of Vanguard. Are you the founder of Vanguard? No, you're not? He wasn't a fan of the high fees from the mutual funds, and he believed that by simply tracking the index, you would be able to outperform the other funds. And truth be told, he was more or less right, with more than 80% of mutual funds not being able to beat the index funds, and this is before taking fees into consideration. Even less than the remaining 20% are even able to outperform the S&P 500. The main idea of index funds is to be passively managed, where they follow a set formula based on market indexes, which means a lower fees for you and me. Index funds comes in two main varieties: an index mutual fund or an index ETF. The main difference is that an index mutual fund can only be traded at the end of the trading day, whereas an ETF can be traded at any time during market hours like any other stock. Some examples of an index mutual fund would be the Fidelity Zero Large Cap Index, with the main selling point of having zero expense ratio, and an example of an index fund ETF being the Vanguard S&P 500 ETF, symbol VOO.
Woo!
Now let's dive into ETFs, also known as Exchange Traded Fund.
Introduced about 15 years after the first index fund, ETFs share many similarities with index funds, with the main difference being that ETFs can be traded anytime the stock market is open. They can be traded just like any stock, and usually, but not always, carry lower fees. Apart from the S&P 500, you can also use ETFs to trade sectors as well. For example, the XLE allows you to buy into top companies related to the energy sector. Looking at the history of it all, we can also see the natural evolution of investing, where it started with mutual funds, followed by index funds, and eventually ETFs. When we first bought into unit trusts, we didn't know that you could only get in or out of the position at the end of the day, which was really frustrating for us when we first started. To us, having the flexibility to get in and out of an investment whenever and however we want was very important to us, which is why we only want to invest in ETFs personally. And in most cases, ETFs will also have lower fees. Apart from the Fidelity Zero Large Cap Index, most mutual funds would have a higher expense ratio or a 2 and 20 split, which we would never think of touching.
If we had to restart investing all over again, we would skip the mutual funds and dive straight into ETFs. And if I do not have the time to do tons of research, then I would simply just dollar cost average into the S&P 500. So for more beginner-friendly videos about stocks, investing and trading and me just giving Sarah a tight slap, hit the subscribe button and comment down below if you have any other questions and we will do our best to reply. Usually it's me.